Does having an LLC mean you are going to pay more in taxes? Well, yes and no. It all depends on your own specific situation, which we're gonna jump into here in this video. For those of you that don't know, my name is Matt Bontrager and I'm a CPA. My firm TrueBooks specializes in helping small business owners and real estate investors save money on their taxes. And that's because we're advisors. We do tax preparation where we collect your documents and things like that, but we focus on tax strategy, which is what we're gonna jump into this video, specifically around LLCs. So as I said at the beginning, it really depends on your specific situation to see what kind of entity, LLC, you need for your business and what's going to help you the most. Because again, it's very fact and circumstantial and depends on your specific situation. So let's start off with what an LLC is. An LLC is a limited liability company. It is a formal legal entity set up in whatever state that you live in. And yes, you can set up LLCs in different states, but let me start with, I'm not an attorney. I'm a licensed CPA, a certified public accountant. So this is not official legal advice. And so just take it with a grain of sand as to, this should get your wheels spinning to think, oh yeah, this sounds like it's my situation. This is something I should talk to my tax advisor about. And so the first thing to mention is you can set up an LLC in any state, but most of the time it's going to be best to set up an LLC in the state in which you are planning to do business. So I get it. I live in Nevada. We are next door to California. California has much higher tax rates than Nevada, as Nevada doesn't even have a state income tax. So for example, if I live in California, but would like to set up an entity in Nevada to try and avoid California income tax, that's not gonna work. I would still be subject to California state income tax, even if I set up an LLC in Nevada, but I'm still doing business in California. So just a quick note there as to, don't think you'll avoid any sort of taxes specifically to each state just by setting up an entity outside of that state, because then you jump into a topic called nexus, which really matters to where is the business being done. Now back to LLCs, typically a limited liability company, an LLC, is what you want to start with. We're gonna go over 4 different tax classifications that an LLC can have. And the first thing I wanna note is, for example, one of those 4 is a C corporation or an S corporation or a partnership. Those themselves in the name are actual entities that you can also set up in your state. So for example, I can set up an LLC and choose to have it taxed as a C corporation, or I can actually set up a corporation and have it taxed as a C corporation. So you see where there's multiple different types of legal structures that you can set up. And what we're focused on today is the LLC itself. But then just remember, when it comes to taxes in the IRS, that LLC can be taxed as different things. And just keep that in mind as you have an LLC, and depending on what kind of badge it wears, that is the type of taxable entity you are to the IRS. And the first thing I want to talk about is a single member LLC, which is considered to be a disregarded LLC. This is a type of entity that you will set up when you start a business for the first time, when you buy a rental property and want to put that property in an LLC. And the reason we call it disregarded is because it doesn't have its own tax classification. And what you have to remember is when you go out and set up an LLC, the IRS doesn't know anything about that LLC until you get what we call an EIN number, which is your employer identification number. So if you're watching this and you just started your business and you set up an LLC, you are likely going to be considered a single member LLC, meaning you just own it, and that is disregarded for tax treatment, meaning you can just report the activity for that LLC directly on your personal tax return under what we would call a Schedule C. A Schedule C is simply a profit and loss where you would list out your income and expenses for how that business did, and that is how you would report the activity for that LLC on your tax return. And remember, that is a single member LLC, and we consider that to be disregarded for tax purposes. A huge misconception is that immediately when you set up an LLC, you have to file a separate tax return, which as you can see is not the case. And remember, disregarded LLCs are great to start with because they're very flexible. You can end up making a disregarded LLC a C corporation, an S corporation, a partnership, and things like that. So my tip there is disregarded / single member LLCs are very good to start with when it comes to starting a business or investing into real estate. And it's typically what a legal professional or CPA would recommend you start with because of that flexibility while still giving you the legal protection that you sought out for. And so you can see in this example of a disregarded LLC or a single member LLC, there's no real tax savings at all for having an entity there, because all you've done now is set up a legal entity to ideally shield you from any sort of wrongdoing that you would have happen in your business. So maybe the cost to set up the LLC in Nevada, that's $425. Sure, you could consider that a tax savings because now that's a deduction that you ultimately are going to lower your tax bill with. But think about it, you still had to spend $425. So when you think about it from a tax perspective, having a disregarded LLC or single member LLC doesn't really help you with your taxes in that situation. Okay, now what's the second type of way an LLC can be taxed? That is going to be a C corporation. We are talking about having an LLC, a limited liability company, taxed as a C corporation. Most of the time, small business owners or real estate investors aren't using C corporations in their overall structure. Main reason being, these entities are typically used for companies that are going to go public, let's say, and you're going to have a lot of shareholders. And you've probably heard of the term double taxation. It's not really tax advantageous to operate your business as a C corporation most of the time, especially if you're a small business. Now, it's important to note that, remember the disregarded and single member LLC talk, you didn't have to file a separate tax return. It was disregarded for IRS purposes, meaning you can report that activity really wherever you want. It just has to be reported to the IRS, typically on your personal tax return. A C corporation files its own separate tax return. That is going to be Form 1120, 1120. And that is a separate federal tax return that you would file with the IRS, letting them know what information is necessary for that business. The income, the expenses, the name, the shareholders, all of that jazz. So remember, C corporations, double taxation, typically used for large businesses, Amazon, Google, eBay, things like that, where you're going to have a lot of shareholders, maybe go public one day, typically doesn't work for the little guy. And you are going to have a separate tax return for that entity. And C corporations, remember, have a flat 21% tax rate, which sounds nice because you're up in the 30s for your individual tax rates. But remember, you have double taxation. So there's a chance where you're going to pay 21% on your earnings from the C Corp. But then if you pay yourself, you're going to pay upwards into the 30% on taxes there. So there's that double taxation component. The next type I want to talk about is an S corporation. An S corporation is very common among small businesses. And that's because you kind of get the best of both worlds between a C corporation and a just regular disregarded LLC. And the reason is you're going to get what we call pass-through taxation, meaning if my S corporation makes $100,000, I ultimately will pay tax on that $100,000 at the individual level, meaning here's my business, here's my individual self, that income will flow through to my individual tax return. I will pay tax at my individual level. Now remember, a C corporation is a separate taxable entity and pays its own tax, meaning it doesn't only file its own tax return, you also are going to pay tax from the C corporation itself. Think of it as it's its own individual in the eyes of the IRS. An S corporation does not pay its own tax. It has its own tax return, sure, but ultimately the income and expenses flow through to the individual who owns it, or individuals, shareholders who own it, and they will pay tax at the individual level. So you avoid that double taxation component like what you get hit with on the C Corp level. Now, a couple other things to note with an S corporation: you can't have more than 100 shareholders. You can't have specially allocated stock, meaning C corporations, you can have A-class stock, B-class stock. In an S corporation, you have to have one class of stock, meaning you can't show treatment between shareholders differently. They all have to own the same amount of stock. And another piece to an S corporation is you have to have reasonable compensation. So some of you may have heard that when you operate as an S corporation, you have to pay yourself a salary. And yes, that is true. If you have an S corporation, and let's say you're a realtor and you run a realtor business, you are now not only the employer, you are the employee. You own the entire business. And so as an S corporation, because it is so helpful when it comes to tax strategy, you have to pay yourself a reasonable wage so that the IRS makes sure to get their fair share. Now, we talked about how disregarded entities, really no tax help. It's just a legal play. So luckily with the S corporation, you avoid that double taxation and it all flows through to you personally, which allows you to tax plan better. And that brings me to S corporations will save you on taxes. This is a good tax strategy. So a disregarded entity, not too much tax savings. Now the C corporation, sure, you get a 21% tax rate, but then you also have double taxation because you have to pay yourself, which also could be upwards of 30%. Double taxation there with the C corp doesn't really help you. S corporations though, remember we have pass-through taxation, meaning we're gonna get taxed at the individual level, but it also allows us to mitigate self-employment tax. So now S corporations can really help you when it comes to taxes. And here's an example that I want to go over. So here's an example of how this would play out. We have somebody that does not have an S corporation and we have somebody that does have an S corporation. You'll see in each scenario, this person makes 100 grand. We'll round up for the numbers. Then we have expenses of 20. And then we have this wage right here that they are going to pay themselves a $40,000 wage. So you could say that each person is going to net 80 grand because remember this 40 grand right here is paid to the owner anyways. It's their own salary. So each person here is going to make 80 grand. This right here is the self-employment tax piece that remember is in addition to federal tax. So not only are we worried about the federal side, but you're worried about the self-employment tax piece too. This is an additional 15%. Now that you're the employee and the employer, you have to pay both sides, 7.5, 7.5. When you had a W-2 job, you likely were withholding 7.5 and your employer was paying the other 7.5. Now that you're the business owner, you're both. So back to this example here's the kicker of how an S corporation really helps business owners is with this self-employment tax, you are only going to be taxed as self-employment tax on the wage you pay yourself, not the entire net income. And that's what happens in this scenario right here. You are going to pay 15% on this 80, which is, as you can see here, 12 grand, versus you only paying self-employment tax on the 40, which would only be 6. So you can see you go from 12K to 6K in savings. And that's simply just by making an election to be treated as an S corporation. And remember, that is you taking your LLC and telling your accountant and obviously talking with your advisor, hey, I think I'm ready for an S corp. And they simply fill out a 2-page form, Form 2553, telling the IRS that you would like to treat your LLC as an S corporation. And that is where you would get tax savings from actually having this sort of entity structure. Because you can see, disregarded / single member LLC, not a lot of tax savings, really nothing at all. It's just a legal play. All right, well, C corporation. Okay, could be some tax savings, but mostly not going to work for the small guy. And then you get to the S corporation where that is what most small businesses are going to operate as because it allows you to really shelter yourself from that self-employment tax when you already have to worry about federal income tax too. And the last thing I'll say on S corporations is, as somebody that works with a lot of real estate investors, I want to warn you, it is not good to own appreciating assets inside of an S corporation. And the main reason being you lose flexibility when it comes to moving those assets in and out. See, when you're taxed as a disregarded LLC or a partnership, which we'll get into next, it's very flexible. You can move assets inside and out without it really triggering a taxable event. When it comes to a C corporation or an S corporation or that corporation style of taxation, if you move an asset in or out, it could trigger a taxable event. And so simply, let's say, moving a rental property outside of your S corp to your individual self, so really moving it between your own entities, your individual self and this entity, that could trigger a taxable gain and really hurt you tax-wise. So rule of thumb, never own appreciating assets inside of an S corporation. And the last one I want to talk about is partnerships. And so again, at the state level, you could set up an LLC and then tell the IRS, hey, this is taxed as a partnership, meaning we have multiple members that own this entity. But remember, at the state level, you can also set up, instead of an LLC taxed as a partnership, you can set up an actual domestic partnership or general partnership or limited partnership. Again, from my experience, you'd be better off setting up an LLC, taxing it as a partnership, because you get both. You get the flexibility of tax benefits there, and then you also get the legal protection that you sought out for. So if you think you're in between, maybe needing one or the other, make sure to consult somebody like an attorney to help you set that up. And partnerships are fairly simple. They work similar to an S corporation, but it is a partnership that has members versus corporations that have shareholders. And so I want to show you a quick example of what I mean by pass-through taxation and having multiple owners that share in the income. So as I mentioned, you have pass-through taxation. And so you've probably heard the term Schedule K1 or Form K1. And as a partnership tax return, which is also to note, you will file a separate tax return for a partnership. Each partner is going to get a K1, which gives them their portion of income. So this is the example. Let's say that you have a Form 1065, which is the federal tax form for a partnership. And let's say that that business netted 90 grand. Well, if this business was owned evenly, let's say a third, a third, a third between three people, each one of these partners would be hit with their respective incomes of $30. And this would come to them on a Form K1. Each one of them would get this form. And it's important to note that that's why S corporations, which also have K1s, partnerships, which have K1s, are due March 15th instead of April 15th, because you need time to get those tax returns done to get the investors and the owners their K1s so that they can file their personal tax returns. Now, we talked about the different tax classifications for these LLCs, but let's run through a really quick checklist of when you have to file these tax returns. So the first one was disregarded. Most of the time, that means you're going to file that on your individual tax return, right? Let's say it's your business. You're going to file it on a Schedule C, and that is due April 15th every year. If you're a C corporation, that tax return is a separate tax return now, and that is due April 15th every year as well. Now, when it comes to partnerships and S corporations, remember, those have K1s. Those are going to be due March 15th to, again, allow a month or so to get those K1s out to the investors and the members so that they can end up filing their own individual tax returns. Now, keep in mind, you can extend these tax returns as well, which gives you 6 months to do so. So for example, if you file an extension for an S corporation, you are going to get from March 15th to September 15th. If you file an extension on your individual return or your C Corp return, you're going to get an extension until October 15th. So just remember that each one of those tax classifications potentially has a different date of when that tax return is due. So in close, do LLCs help you or hurt you when it comes to your taxes? And you can see it depends on where your business is and depends on what type of entity you have that will play a role in whether it helps or hurts you. Most of the time, we like to look at LLCs as a legal protection play. But remember that S corporation, if you're netting at least 50 grand or so, it's likely going to make sense to tax your business as an S corporation, which could help you save on some of that self-employment tax. Now, as you can see, this is a ton of information. So if as you're watching this, you have other questions and other things that you want me to maybe talk about, feel free to comment and let me know what that is, and maybe we can make a video on it. And as always, feel free to like, share. If you know somebody else that can use this video, maybe help them in their own business journey, feel free to send this to them so that it can help them as well. And until next time, cheers.